Hello and welcome to the first ever episode of Market Wake Up, the show that's going to get you up to date with everything that's happening in the macro world ahead of your trading day so you can trade with clarity and conviction. I'm going to show you a little intro just before we get in. Guys, welcome to Market Wake Up. It's just gone 8:30 a.m. British Standard Time. Let's get into it. Jon, tuning in from Spain. How you doing?
I'm doing really well, mate. Actually, I quite enjoyed it, because obviously because the weather's nice, so it's just a happier place to wake up to. And you've got, yeah.
It's almost like I've been telling you this for years, Jon.
Yeah, I know, and. So that factor's lovely because you can just sit out in the sun and enjoy it. There's a beautiful sunset by the villa. Last night that I was watching with a beer, and beer tastes better as well in the sun, doesn't it? So it's been quite enjoyable so far. It's quite nice as well because of the time difference as well. So it's an hour ahead of the UK. So I felt like I could just prepare myself this morning. I got up quite early. Had a coffee, got a nice coffee going on, and then, had a bit of breakfast, just chilled. Whereas usually I feel like I get up early and then I'm like scrambling around. But I feel like the Spanish way of life is good for me. Maybe I should call myself Juan, and that should be it now. I should just stay here.
Well, actually, you won't want to be calling yourself that because it's too close to the Chinese currency, and we can chat on what that's doing at the moment. But that's I'm really proud of that segue. But no, I'm glad you're enjoying your little trip, guys. Welcome to Market Wake Up, our first ever episode on this channel. So if you haven't already, hit the subscribe button. Make sure you hit like and type in chat. We can bring you guys up. Good afternoon, Muscle and Andrew as well. Welcome into the new channel. Super excited. So what we're going to be doing every day, Monday to Friday, 8:30 a.m. British Standard Time, is getting everyone up to date with what you need to know in the markets and what's been happening. And because we didn't do a stream yesterday, we actually have missed a little bit when it comes to market makeover. I wrote in my notes this morning, so I woke up and kind of did my review this morning. This was prior to China doing anything, that the Chinese were likely to cut rates. And then I had my usual working day and got towards the close of the day and got a message from you saying, have you been keeping an eye on the China situation? And I thought, this is interesting. And it looks like they've cut rates. So they were thinking about it, but then they've just straight out cut them. Interesting. I haven't done a whole lot of research on it, but I know they're moving. What do you know?
Not a lot, I must admit. It was obviously being on holiday. I haven't looked into it too much, but there was a report that I sent over to you that was just talking about how they've done one of the most sort of dramatic changes in a very, very long time. Cut interest rates. They've also given some interesting sort of what can we say? Interesting sort of incentives for mortgage owners and things like that. They're basically trying to support the housing market, which is what you were talking about a while ago. And that's very, very interesting to see because the market has reacted very well to this in terms of we've seen equities up very, very strong today. I was watching Bloomberg and I was watching the Open and it just lit up green. As soon as they were talking, it just lit up green. FTSE was up. DAX was up, the CAC was up, everything was up, and it was just like, okay, so the markets really wanted this. We saw oil up as well. This little bit of stimulus from China is really having a big impact on markets going into this morning. I haven't had time to kind of go through the intricacies of it. We know that they've obviously cut the sort of purchases as well for second homeowners to 15% from 25%. So that's a big cut as well. Again, incentivizing people to own a second home, I guess, as well. So yeah, some big moves there. And I was looking at the Hang Seng this morning. The Hang Seng was in a really nice place a couple of weeks ago. And I can't remember if I mentioned it on stream, but it was in a very, very nice place, and it has rebounded quite nicely this morning, and we're seeing quite a big upside move there. But Yeah, I think this stimulus was something that a lot of analysts were calling for. Whether they'll add further stimulus from this, who knows? But they have been adding stimulus for a while now, haven't they? I think they've cut rates a couple of times recently. So, yeah, now they've made kind of more aggressive stimulus cuts, I guess. Is that narrative going to be like, okay, it's time to be going with China, investing in China?
We spoke about this months ago, didn't we? I brought this forward talking about the floor in the housing market, and that the government really they don't want it to get past a certain level. It's approaching that level, and you're starting to see that they do not want it to drop past that level, because stimulus is now being projected and put in, and it is really interesting. I never found a way in. I did want to get a part of that floor. I think you're going to find momentary weakness as people kind of panic that China's having to actually come out and do this. But I think you'll realize where that floor is very, very soon. And you will see a lot of people buying up on this opportunity. And these incentives, they are incentives, and they generally will get the general public going, maybe I should buy a second home. Maybe I should buy an investment property, or while we're bottoming out here, or what we could project to be. So I think you will see a fair bit of demand come in and around there. I want to get back to probably currencies that most of our guys will trade. And let us know in the chat what your major currencies are. Yesterday, we had a lot of news out of the EU. The services and manufacturing PMIs come out of the EU. Nothing but red. Nothing but red. Everything missed targets. It really did. French, German, the euro as a whole, even the British PMIs, nothing but red across the board. Interesting to see. Very, very interesting to see. My biggest takeaway, obviously, German manufacturing PMI from 42.4 down to 40.3. Not pretty. We saw a lot of sell-offs in the euro yesterday as well, which is... I'm going to talk about it in the big bite. I'm going to have a chat about EU today. I know Rich is already talking about EU in the wild trades, looking at UJ, but I am going to talk about that. But in terms of market leftovers, what I want you to kind of to take is weak data out of Britain, weak data out of Europe the past 2 days. Okay. This morning, RBA's decided to hold rates. There was a lot of pressure on cut rates. The RBA has decided to hold. So Australia is not cutting rates. Not sure how I feel about it. I think that this reminds me a lot of the US situation, which we have obviously to talk about. It's cutting rates for stimulus, but why? And I think that's what the RBA is kind of sitting on. They're getting so much pressure. Cut the rates. And they're looking at the data going, why? We don't need stimulus. Why would I cut the rates? We don't need that. And I think that's very much where the RBA is sitting. They're like, we can hear you. We understand you want rates to go back down to 0.25% because everyone does, because it's free money. But no, we don't need it. And they're holding steady, which I think is a very sensible approach. I know I've given the RBA some stick the past few months. I really ripped into their decision making. This one I can get behind.
Yeah, well, you're in the best position to kind of talk about this because obviously you're there, you live in it, so you understand kind of how you're feeling in the situation, which is the best sort of barometer I think for looking at sort of economics, because economics is technically life, right? So yeah, it's interesting from that point of view. I did see they were saying something about underlying inflation pressures were still too high for them to consider rate cuts just yet. So obviously, I think the governor pointed towards immigration as being a big influence on the factors of that underlying inflation. So yeah, there's a bit of political chat in there, I guess, as well as what's going on in terms of the inflation picture. But like we've been talking about for a while, I mean, we were thinking that the RBA at one point would be hiking rather than cutting. They then cut, and then now they're on this kind of hold situation. So yeah, I think a lot of yeah, exactly. That it's funny the inflation picture's kind of rearing its ugly head again, and this is the state that we're in now, because we were talking about this a couple of months ago. We were saying, are they going to cut to appease the public, and then is it going to be, okay, right, we've got to hold now. We've got to hold for a very, a longer picture to try and bring this inflation under control.
Europe.
Yeah.
Europe. Right.
Well, I mean, ECB stimulus is not really helping Germany at the moment, and it probably won't see that for a while. But it's when that German number came out yesterday, I was a bit like, oh, okay, yep, it's a German doing poor again.
Yeah, I mean, we spoke about that, right? And the insights on the ground with BMW and Volkswagen closing down factories and things like that. We knew the manufacturing wasn't going to be pretty. I didn't expect it to get us down to the 40, almost below 40. We don't want to be going below 40 on a PMI index. Like that's not good. That's not, you don't want to be down there, specifically when it's one of your biggest money makers as an economy and one of your bigger employees. Let's jump into Freshly Squeezed and get you up to date with everything that's happening right now, what the prices are actually having a look at. And I want to show you guys the VIX, because the S&P has been punching all-time highs again. We're running on the VIX, which is very interesting. And having a look across kind of the board, you can see the VIX on your main screen right now. You can see we're priced in at 1597 as we're just falling off back towards those lows around that 15 whole number. Aussie dollars down 0.25% after that news out of China, which isn't ideal for the Aussie dollar. We know they're the biggest trade partners, as well as not cutting rates. Plus, Australian CPI is out tomorrow, year over year, which is expected to come in, I think it's 3.4 into 2.7. We're losing September last year. Remember, year on to year figures are a rolling average of the year. So when you bring in a new figure, which will be September 2024, September, which will actually be based on August, but September 2024 figure comes out, it means you're going to remove September 2023 from that equation. September 2023, I think, was a 3.8. I'm taking a swing. I think it was a 3.8%, and then we're going to replace it with maybe a 2% or something like that. So you can expect a rather large drop on Australian CPI tomorrow. It doesn't necessarily mean the picture's changed. We're just removing a big number from the past. So keep that in mind. So Aussie dollar is down 0.2%. The euro is up 0.1. The pound pretty much flat. The US dollar CAD down 0.15. US dollar Japanese yen up 0.55. The XJO, as John mentioned, indices kind of moving. The XJO is up 0.3%. The DAX is up 0.5%. The Nikkei is down 0.4%. The FTSE is up 0.3%, and the S&P 500 up 0.16%. $5,724 for a piece of that indice. Wow. Coffee is up 4.4%. Gold down 0.14%, finally seeing a bit of sell-off, but that's been moving up with the S&P, which is another interesting factor. Nat gas up 0.5%, silver up 0.5%, pushing those 30.8 levels now. Sugar up 0.45%, and oil up 0.5%, getting back into retest those levels, which we've spoken about there on oil. Let me go ahead and show you really quick. You can see we're approaching that 72.50 area, which is where we've seen a lot of rejection in the past. So keep an eye on oil as we do get a little bit closer. Bitcoin pretty much unchanged. Ethereum down 0.2%, but those really are unchanged. Aussie 10-year yields down 1.2%. 30-year yields down 0.6%. US 10-year yields up 0.5%. And US 30-year yields up 0.63%. So people starting to price in that they're quite happy, and they're going to see a little bit, at least in the US there, that they're not going to see too much rate change from what is expected, with those yields starting to gain a little bit of strength there, which I find quite interesting. Is there anything today that you want to be wary of, John, moving into the trading day?
Not really. I'm just looking at the economic calendar. There is some consumer confidence coming up this afternoon at 3:00. We've also got a Bank of Canada Macklem speaking. BOJ Governor Wada spoke earlier, and basically, which I thought was quite interesting, just a kind of side note, basically said that markets are still sort of say unreliable or still kind of volatile, right? So that's quite interesting, because the previous comments from them said that they wouldn't do anything to their interest rates while markets were uncertain and volatile. So they come out and basically reiterated that picture. So that's quite interesting to take note of. But yeah, nothing. I can't see anything really on the calendar that's going to open me up. Although I am sitting on the red folder news calendar, not open my calendar up. So yeah, I just think, yeah, by the looks of it, it's the CV consumer confidence later that's going to be a big factor, which is interesting considering what's happening in the US equities at the moment, breaching all-time highs and, making new highs, seems to be sustaining above those highs as well. This is something that is quite interesting to me at the moment because, both of us, I guess, because we have been quite vocal in what we think could happen with in US equities. So just waiting to see if that picture or narrative does start to play out.
Yeah, I mean, we're very vocal about our opinions, and that's the point of this show, right? It's because we're traders. We're not analysts. It's not our job to sit here and say what we think economists might do. We trade it. So we bet on what we think. And that's why we think you guys enjoy it more, because we put our money where our mouth is when we're backing this stuff. And, I still am sitting at the US recession. Soft landing is so hard to achieve. We've achieved, I think, 1 in 10 over the last 10 recessions. We've achieved a soft landing once, which was the mid-90s. And the volatility that led us into that recession was next to nothing. Like it was a recession, but it was kind of one of those regulatory, this is pretty healthy. Whereas... Yeah. The price action we've seen over the past couple of years, I'm going to argue, is a little bit more whoa. I think it's very difficult to assume we're going to hit a soft landing. Every recession starts with a soft landing. You don't realize till afterwards that the landing wasn't as soft, right? You land a plane, you're like, oh, we're on the ground. You get out and you see that all the tires are popped and you've lost a wheel. Right, that wasn't a soft landing, right? You landed, yeah, but it wasn't always soft. So let me tell you that a lot of media will promote, we did it, we got a soft landing. Every recession in history, you get a little bit of a soft landing to begin with, and then it hits the fan. Remember, we were cutting rates September 2007. We didn't feel the full force of those rates till mid 2008. Right, there was a lot that changed. You can look back at 2001, you can look back into the 90s, you can look back late 90s, you can look in the early 80s. Same thing. They all start with, hey, this ain't too bad. And then someone punches someone in the jaw and something happens, right? So keep that in mind while we're printing positive, and it's like, hey, this is pretty good. We might have hit a soft landing. Every recession starts with a soft landing. In history, every recession starts with a soft landing. I still think a recession is due. I still think it'll be a rather large one, but nevertheless, it doesn't matter, right? What matters is we make money from it. That's what we're here to do. So how do we bet on that? So I'm going to actually make the change into the big bite. Now, I'm going to talk something fun.
Ooh, okay. I'm ready for this.
I'm going to talk about EU. I'm going to talk about the euro, right?
No, it's not fun for me, Jordon.
So far out of left field that I'm quite excited to talk about EU. Okay, so I've been a fan of really getting behind the US dollar recently, buying the US dollar, right? I think it's been shorted too much and I want to take it a little bit higher. So I've been looking for ways to do that. And the way that I've found is EU is a little seasonal play late September. Right, late September seasonal play. After seeing the incredible amount of weakness we were hit with yesterday out of Germany once again, and even through France, and then seeing even Britain out there not doing too great on those manufacturing PMIs and services PMIs, I'm like, okay, I think there's going to be some room for downside here, considering it's also pushing highs. And there's a seasonal play late September here against the US dollar, which you can see 70% of the time we drop down. Now, I don't want to read too much into this seasonal play. I just want to be aware it's there. I'm looking over the past 20 years. Late September, historically, it's not a good time to be an investor in Europe. All right, it's not. Late September, it doesn't too great. So then I swapped over to your friend. I went over to Markets Made Clear and I did a little bit more digging. What we have here is the euro, obviously more on the futures, but it's still euro US dollar. And I've got a what if scenario, a custom, which is the blue line here. And that is what if August was positive. Okay, because we had a very positive August. Now, we actually have an 84% correlation right now with if August was positive with all those years. There's about 7 of them. And what we did see is mid-September, we topped and then we fell right the way through, all the way down towards Christmas. just fell off, right? Some of those years were actually an election year as well, which was quite interesting. And that correlation there is giving me a little bit more confidence going, okay, I could have a look into Europe here. I could have a look into the euro. The correlation's pretty good. There, get it out. Pretty good. It's something I can back. Fundamentally, I like the idea of buying the US dollar. I know the data coming out of Europe is weak currently, and that's not ideal. If I can get a seasonal play that backs it as well, which I found one which shows weakness in late September into early October, and then I found this, which is more niche, right, which goes all the way to late November, where I can find some downside. Let's get over on the charts. Now, on the EU as a whole, we're very close to hitting a double top, up at these highs at around the 1.12s, right? We're getting up to those 112s. We're sitting around at a double top. I've overlaid a chart on here, and you can see, oh, no, you can't see, sorry. I've overlaid a chart on here, and you can see that. Do you know what chart I've overlaid here, John?
Well, it kind of looks like the S&P.
It is the S&P. It is the S&P indeed. Yeah. And look at the correlation we've kind of been having between Europe and the EU and the S&P. We are seeing a fairly decent correlation in there. The only difference is, the only divergence is the S&P is breaking all-time highs, still in that double top formation, whereas Europe is not. We're not breaking their all-time highs, but still forming that kind of cross in and around that level. This doesn't add to my... I know, I'm short the S&P. I think breaking all-time highs now is just the most ridiculous thing I've ever seen. I've been very vocal about that. I don't hide that. I'm not hiding from that. If this thing rips all the way to 12,000, I'm still going to sit there saying this is dumb. Right? I don't care. I'm sticking by my opinion there. So I'm short. So I'm adding this as correlation because I'm short the S&P and I think we will come down. Euro correlating so heavily has been really, really interesting to me. It doesn't necessarily add to my analysis. It's just one of those things that I found so interesting. I had to share it with you. So there you go. Yeah. I overlaid the S&P chart on there and the correlation's pretty good. But as a whole, I am looking to see if we can find a way to get short. There are so many areas, price action wise, technical wise, that I think we can test in and around. Do I think we're getting all the way down to parity? No. I think that's a ridiculous. I don't think anyone ever in history of Europe has said we should be at parity. And if they have, I think they're wrong. But that's a little dig at you there. But no,
it is a little dig.
I think we can see some weakness in the EU coming towards the end of the year there. I think there's a lot of risk. It's not something I'd be positioning heavily for, but I do think there's Barry's dropped in and said if it's not 2000 S&P, I'm not interested. 2007 S&P, I understand, but it could be, right? We're 2024 S&P, so it's pretty much the same thing. But no, big bite today, seasonal play, fundamental play, Euro short, I like. I think you compare it against something probably a little bit better than the US dollar or less volatile right now than the US dollar. However, I think there's more value in the US dollar potential. So I think the risk to reward with being exposed short on this pair outweighs not being exposed.
Yeah, I like this a lot because I think the euro is overvalued against the US dollar, right? Because if you look at euro again across other assets, it's performing poorly. Like euro pound broke into new lows. We've seen a little bit of recovery against the Swiss franc, but that's more kind of your risk on, risk off situation going on at the moment. But euro against other currencies has not been performing very well at all, and that's because of the underlying data, right? Underlying data out of Europe is not good, right? We've seen a lot of stimulus come from the ECB recently, but you can see in those manufacturing and services PMIs there, Europe's not doing well at all, and this is an interesting sort of thing for me because the euro dollar is so elevated. It's at 112, all because of the US dollar. The dollar dominance in this currency pair is what's really caused this uplift, which has made it hard for me to be a buyer of euro dollar, right? Mm-hmm. Because I didn't see the value in being a buyer of the euro. So I've not took any euro dollar longs at all. And I missed out on a large sort of trend over the past few months because I didn't expect euro dollar to reach the highs that it reached, obviously. But yeah, the 112 looks overpriced for me. It looks, yeah, I don't like buying it up at these prices here. I was doing a little bit of analysis of euro dollar over the weekend. I was having a look around at sort of COT reports. Nothing really on the COT reports apart from a dollar index point of view. We've seen some really aggressive repositioning from the commitment of trader reports on the US dollar at the moment, which is something I'll talk about in another big bite. But that combined with the fact that the US dollar could be starting to make a little bit of a turnaround, euro a little bit weaker. I like the idea of being short. Also as well, I was looking at retail sentiment, and retail sentiment at the moment, they are aggressively short euro dollar, which makes me think that there might be another top in this, or we might just try and push these highs. I'll be very interested if we push these highs, right, and then we fail those highs. I'll be interested in shorts, I think. Interesting.
Look, do you think we got the legs to get up?
That's another question. I don't know, but it would make a lot of sense to me. Because I think if we did push those, I think retail would be like, okay, we're very wrong. We've got to bail out of these positions. And usually we see kind of a top in that market. I was looking at the futures market in terms of and looking at sort of dollar index on a commitment of trader report idea. And the repositioning from COT is actually quite scary at the moment. The non-commercials have reduced their long positioning by 50% over the week. Last week as well, commercials minus 82% change in the short contracts there. So starting to see a massive decrease in shorts from commercials, which could be a little bit of longing coming in. And then you've got obviously the non-commercials aggressively reducing long positions. So it almost works as like a little bit of an extreme factor there. And when we've looked at extremes in the past, they've been familiar with sort of turning points in the market. I think the dollar is at a really interesting point now. We're either going to see the catalyst where the dollar breaks those lows and it's going to go, and it's going to really go. Or we're going to start seeing this little reversal pattern. A lot of what I've seen online is that everyone thinks the dollar's doom and gloom and it's gone.
That's usually a sign that it's not. You hear the crowd pushing a certain way, usually means it's going to do the opposite, which actually tested theory. I told you about those hedge fund guys that did that. They had like 1 million followers on Twitter, and they'd put out polls. And they'd just do the opposite of what the poll said, and they made ridiculous amounts of money. It was like, I really want to do it. I want to get more market wake up so big that we can put a poll out there on Twitter and see if we just do the opposite of the poll, if it works. I hope we have an audience that won't do that. But I also find
that's the thing. If we get a big enough audience and they do the opposite, then they might join in, and then it goes the right way.
Exactly. You mentioned there that we're either going to break through the floor and drop off a cliff, or we're going to bounce and run. You're a trader. Probability-wise, what do you think is more likely?
I'm favouring the bounce. I'm favouring
the bounce in the dollar and a bit of strength?
Probability-wise, I'm probably 70% on a bounce.
70%. Okay. Yeah, I like it.
Yep.
I'd be close.
But, I've got to wait for them technical factors to increase before I start getting aggressive on this.
We'll talk about it. We'll talk about what those technical factors are. Guys, thank you so much for joining us here on Market Wake Up, our brand new channel, our brand new show. If you haven't already, make sure you subscribe. Leave a comment after the stream's done down the bottom. We'll favorite it, and our favorite one will get a free prize. I don't know what it is. I'm just making this up as I go. But I hope you all have a fantastic trading day. I'm going to pop over to Rich's channel, London Live Trading Floor, and do some live trading. But in the meantime, guys, we'll be back tomorrow at 8:30 a.m. British Standard Time to do it all again and to talk more trading. Thanks for joining us. Without further ado, see you later.
Peace.